What is a yield curve inversion? How does it relate to financial crisis? And does it signal anything for the gold market? Yield curves relate to the bond market. You can set the different maturities on bonds side by side to make a curve. The curve is built from the 1 month, 3 month through to the 1 year, 5 year, 10 year, and on the far curve is the 30-year bond. Due to the different time differences in how long it takes each bond to mature, each of the bonds that make up the curve pay different interest rates, and under normal conditions, the longer the bond takes to mature, the higher the interest rate goes. The reason why far dated bonds generate more interest is because you don't get your money back for longer, so the bondholder should generate more interest in payment to you to compensate you for this. You're also exposed to more inflation risk because as time goes on, there's always a risk that inflation could increase and erode some of your interest payments. The most widely watched indicator of yield curve inversions is the 2 year and the 10-year bond. If I was to buy the 2 year bond and the 10-year bond, the 10-year under normal conditions would pay me a higher interest rate. However, sometimes economic developments disrupt this and cause the yield curve to invert, in which short term bonds have a higher yield or interest payment than longer term bonds. This is often interpreted as an early warning signal of an impending crash. But why does this happen? When bond investors are expecting a recession, they look to lock in higher yields before future rate cuts. If investors expect interest rates to fall in the future, they rush to lock in higher yields on long term bonds before those yields drop. This increases demand for long term bonds, driving their prices up and, by extension, their yields down. At the same time, selling short term bonds can drive short term yields higher. Suppose the 10-year Treasury bond is yielding 4% today. If investors expect the Federal Reserve to cut interest rates next year, then potentially the yield could go down to 3%. So buying the 10-year bond today would ensure that they are guaranteed a 4% yield. But in doing that buy in, you're pushing the bond price up, and by default, the yield will go down. If investors fear a recession in the next year, they would expect the Federal Reserve to cut interest rates. Instead of investing in short term bonds, which will need to be reinvested potentially at lower rates, they can just invest in longer term bonds, which can secure that income for a longer period of time. If investors fear a recession in the coming 12 months, they would naturally expect the Federal Reserve to cut interest rates in order to stimulate the economy. Instead of holding a 2 year bond, which will mature soon, they would rather buy a 10-year bond, which will mean that they won't need to reinvest that in 2 years, potentially at a lower interest rate. Risk management also has a key role in determining the yields of bonds. Many institutional investors, such as pension funds and insurance companies, prefer long term assets for liability matching. When uncertainty rises, they shift their portfolios from short term riskier assets, such as stocks or corporate bonds, into long term government bonds. The yields on bonds, such as 2 year and 10-year treasuries, are a telling factor as to what big institutions are forecasting for the economy. So, why does this cause an inverted yield curve? Well, investors buy long term bonds, causing the demand to increase. This pushes up prices of the bond, and then investors need to pay a higher rate to get that same level of interest, which means the yields fall. Investors sell short term bonds, causing the supply to increase. Prices then drop and yields rise. Short term yields rise above long term yields, which makes the inverted yield curve. This inversion signals that investors are expecting lower interest rates and a slowdown in the economy. Other than the European debt crisis in 2012, the spread between 2 year and 10-year bonds significantly narrowed in the period before all major financial crises of this century. The dot-com bubble saw the yield curve invert at the early stage of the crisis, which was the market's way of signaling that interest rate cuts were likely to result from the developments in the economy, which was something that came to pass. The 2 year bond yield closed the gap with the 10-year yield significantly from late 2005, which was a full 2 years before the great financial crisis really made headlines in autumn 2007. The yields were unfazed by the 2012 European debt crisis. I think that this was the market's way of signalling that this was likely to be contained within Europe and was unlikely to lead to a wider contagion. The most interesting thing about this chart is what the bond market has just signaled. In December 2022, saw the yield curve invert and remain inverted for the longest period this century has seen. This is a clear signal from bond traders that something impending will cause interest rates to fall significantly. I think the gold market has sniffed this out and is rising to reinforce the bond market's signal. A good question to ask is, how has gold responded to interest rate inversions in the last century? I've conducted a study in which I looked at the trading session where the bond yields first inverted. I looked at the gold price 100 days before that happened and then 100 days after that happened too, to see how gold performed in the run up to that yield curve inversion, and also 100 days after to see how it impacted the gold price. Gold rallied 11% in the 100 days leading up to February 2000 yield curve inversion, but failed to build on this momentum as prices lost 1% in the 100 days after that first inversion. The December 2005 yield curve inversion saw a much stronger gold price performance, as in the 100 days leading to that inversion, gold had risen 16%, while gaining an impressive 36% in the 100 days thereafter. The 2 and the 10-year bond yields inverted on the 5th of July 2022 and remained inverted for 545 trading sessions. It was only in September of 2024 that yields normalised. Gold was dipping into this yield curve inversion, down 4% in the 100 days prior to the session that the yield curves actually inverted. However, prices surged 14% in the days after the inversion. What is clear is that the bond market and the gold market are both signalling a significant cut in interest rates. Commodity prices are rising, which is increasing the chances of another wave of consumer price inflation. Central banks would normally tighten monetary policy under these conditions, but the bond and gold markets are not buying this, which leads to the conclusion that something else is at play. Since the late 1990s, bond yield inversions have been at times up to 2 years early before an economic crisis, but they've never given any false signals in that period. Either this is the first false signal we've seen since the 90s, or there's something big brewing in the global economy which is going to cause a crisis.